This video is brought to you by Vantage Markets, a global exchange with over 5 million active trading accounts worldwide. Find out more later.
Going back to the 1930s, we encounter an event that many thought marked the final, agonizing death of capitalism itself.
This was the longest, deepest, and most widespread economic downturn in the 20th century. It devastated the global economy. This event also partially led to World War II. I am talking, of course, about the Great Depression.
I'm William,
and let's explore exactly what happened during that catastrophic time. This video is based on research and compilation from multiple credible sources. If anything is factually wrong or needs correction, please comment below.
The Great Depression was a global economic collapse that started in 1929 and dragged on until approximately 1939.
This was the longest and most severe crisis ever seen in the industrialized Western world. Although it began in the United States, it caused a massive drop in production, severe unemployment, and deflation across most nations.
It was a stark warning bell about the very survival of capitalism itself.
Non-Marxist economists argued the crisis was caused by a lack of proper state regulation and excessive government oversight. The question remains, can capitalist governments prevent all future crises?
Many argue the answer is no, because it's a natural law. Where there is growth, there must inevitably be a subsequent recession.
The crisis caused global industrial output to fall by 20%, and nearly half of all U.S. banks failed. Nations became reluctant to engage in international trade, which, in turn, only further slowed down the pace of economic recovery. First, let's quickly delve into the economic history of the period. By contrast, the impact was lighter on Japan and some countries in Latin America. The exact causes of the crisis are extremely complex, involving a sharp drop in consumer demand, financial panics, the gold standard system, which linked global currencies to fixed exchange rates, also helped spread the U.S. recession worldwide.
The recovery process was mainly driven by abandoning the gold standard, expanding monetary policy, and instituting major economic reforms.
Speaking of fundamental changes, I want to introduce you to today's video sponsor, Vantage Markets.
Vantage Markets is a fantastic choice for both novice and experienced traders, offering features tailored to a variety of different needs.
They offer trade execution speeds under 1 millisecond and liquidity from major banks, along with trading tools like auto charts.
Operates by focusing on technology and transparency, aiming to earn traders' trust without relying on excessive flexing or extravagant claims.
They are also an official global partner of Ferrari, so you can bet their transaction speeds are incredibly fast.
You don't need to deposit any cash. Just use a demo account to compete, gain experience, and win a part of the prize money.
The detailed link and registration can be found in the description and comments below. Let's return to the Great Depression. The U.S. was the crisis's biggest victim. It began in late summer 1929 and lasted until 1933. During this period, industrial production fell by 47%, real GDP dropped by 30%, and the wholesale price index.
Get the numbers for a moment and just think. A 47% drop in industrial production means that for every 2 people working, 1 person was laid off.
This was a period of extreme deflation, with the U.S. unemployment rate soaring past 20% at the crisis's peak. During the 81-82 recession, prices were still rising, albeit slower, a phenomenon called disinflation. The crisis was less severe in the UK because the country had already been experiencing slow growth and recession since the late 1920s. However, the UK's return to the gold standard in 1925 at an overvalued exchange rate made the economic situation worse. In France, the recession only began in the 1930s, and the subsequent recovery was relatively brief, lasting from 1932 to 1933. Japan was the last major industrial nation to enter the crisis, starting in 1930, and the overall situation there was not overly severe.
Across most industrialized nations, wholesale prices plummeted by over 30% between 1929 and 1933.
In Japan, prices fell rapidly in 1930 and 1931. This swift deflation may have actually helped. This caused massive damage to all nations relying on the export of agricultural and basic commodities. Now, let's break down the deeper underlying causes that led to the Great Depression.
First, we have the stock market collapse. The 1920s were prosperous, but weren't a period of extreme boom across all sectors.
Commodity prices were relatively stable, and the U.S. even experienced 2 minor recessions in 1924 and 1927.
However, one area was clearly overinflated, the stock market.
Stock prices quadrupled between 1921 and the peak in 1929. This created an obvious stock market bubble. By its very nature, a bubble can burst at any moment, much like the one that burst in 2008. To try and curb speculation, the U.S. Federal Reserve raised interest rates in both 1928 and 1929.
Therefore, when a series of small events caused a slight dip in prices in October 1929, investor confidence evaporated.
They only paid a small fraction of the stock's value and borrowed the rest from banks or brokers.
As stock prices fell, they were forced to liquidate their holdings to cover the debt, accelerating the price plunge.
From its peak in September to its low in November 1929, the relevant stock index dropped by 33%. This collapse severely reduced U.S. aggregate demand. Consumers, having lost their wealth, stopped buying durables like cars. Growing economic uncertainty and fear about the future led people to save more and further cut consumption. This severe slump led directly to our second cause, bank panics and tight monetary policy. After the stock market crash, the U.S. banking system received a fatal blow with the first wave of widespread bank panics in the fall of 1930.
Bank panic occurs when depositors lose confidence in a bank's ability to pay its obligations, causing them to rush to withdraw their cash simultaneously. When too many people withdraw at once, banks must liquidate assets to raise cash, leading to heavy losses and bankruptcy. The U.S. saw 4 waves of bank panics from 1930 to 1933, culminating in the national bank holiday in March 1930.
In the end, 2 out of every 10 U.S. banks failed. The U.S. money supply dropped by a massive 31% between 1929 and 1933. A further reason for the global collapse was the gold standard system. In the gold standard system, gold was used as the basis to determine a currency's value.
When a country exported more than it imported or attracted significant foreign investment, it received a gold inflow from other nations.
Simply put, trade and capital flows were the mechanisms for exchanging gold. Nations that profited gained gold, and those that lost money lost gold. Some economists argue the Fed deliberately allowed or even caused the massive drop in the U.S. money supply to protect the gold standard. This could trigger a run on U.S. gold reserves, forcing the U.S. to either devalue the dollar or abandon the gold standard, as the UK did in 1931. While the gold standard's role in restricting U.S. policy is still debated, it undeniably played a major role in transmitting the U.S. recession globally.
Under the system, if a nation had a trade surplus or a large capital inflow, its gold reserves increased, and vice versa.
The UK returned to the gold standard at the old pre-war price, but war-era inflation meant the pound was overvalued.
As the U.S. recession deepened, gold flowed from other countries to the U.S. This was because U.S. goods became cheaper and U.S. demand...
To stop the gold loss, central banks worldwide had to raise interest rates. This resulted in a global monetary contraction. In 1931, Credit Anstalt, Austria's largest bank, faced solvency problems, triggering a chain of financial crises across Europe.
The cause was generally attributed to poor management at local banks and a contagion effect, which spread from one nation to the next.
Banks' collateral assets lost massive value, making them vulnerable to bank runs and a sudden mass flight to gold as an alternative asset.
The final reason for the global downturn was a sharp change in international lending and trade. The U.S. lent heavily to Germany and Latin America in the mid-1920s. This reluctance caused Germany, Argentina, and Brazil to enter recession before the Great Depression even began in the U.S.
In 1930, the U.S. also enacted the controversial Smoot-Hawley tariff to boost farmer incomes by curbing competition from foreign agricultural products. However, other nations retaliated by implementing their own tariffs, severely hindering global trade. While the tariff wasn't the main cause of the crisis in large industrial nations, it lowered global commodity prices, causing payment crises in commodity exporters.
In summary, the Great Depression was the result of a devastating combination of factors: the stock market crash, bank panics. Since tight monetary policy and the gold standard were the main causes, it's unsurprising that currency devaluation and clear, notable correlation between the moment a country abandoned the gold standard or significantly devalued its currency and its return to economic growth. Similarly, Latin American nations like Argentina and Brazil, which began devaluing in 1929, experienced a much milder. Devaluation didn't directly increase output. Instead, it freed nations to expand their money supply without fearing gold outflow and exchange rate problems. Nations quickly utilized this newfound freedom to boost their recovery efforts. This expansion was primarily driven by a massive gold inflow into the U.S., partly due to rising political tension in Europe, which eventually led to WW2. This global monetary expansion stimulated spending by cutting interest rates and making credit much more accessible.
It also created an expectation of inflation instead of deflation. Borrowers became more confident their future profits would cover the debt. One key sign that monetary policy drove the U.S. recovery is that consumer and business spending on rate-sensitive goods rose.
In fact, the 1932 Revenue Act significantly raised tax rates to balance the budget, which delivered a contractionary blow by reducing spending. Roosevelt's New Deal, launched in early 1933, included federal programs like the WPA to hire the unemployed for public works. This small impact is even clearer when factoring in state government deficits, which actually shrank as federal deficits rose.
Therefore, the direct stimulative effect of the New Deal's new spending was limited, though its positive psychological impact on consumers and
furthermore, many historians argue that U.S. military spending before WW2 was not large enough to significantly impact total spending and output by 1950. According to the numbers, fiscal policy was far more effectively used in Germany and Japan. Germany's deficit to GDP rate. In Japan, government spending, particularly military spending, rose from 31% to 38% between 1930. This fiscal policy, conjugated with significant monetary expansion and an undervalued yen, allowed the Japanese economy. All countries eventually recovered, the global economy was left with several deep and lasting consequences.
The most obvious impact of the Great Depression was the immense human suffering caused by the sharp decline in global economic output. Life plummeted for many. In the 1930s, up to 1/4 of the labor force in industrialized nations couldn't find a job.
The Depression and the government's responses fundamentally changed the world economy in several ways.
One of the biggest consequences was the official end of the gold standard regime. While the Bretton Woods system later maintained fixed exchange rates, global economies no longer placed absolute faith in it. Fixed exchange rates were officially abandoned in 1973 for the floating rates we have today.
Unions and social welfare systems also expanded greatly in the 1930s. In the U.S., union membership doubled between 1930 and 1940.
This had two causes. High unemployment fostered worker solidarity, and the U.S. government passed the National Labor Relations Act.
The U.S. also passed the Social Security Act, 1935, creating unemployment insurance and retirement benefits.
While many European nations already had robust pension and union systems, the Depression accelerated the expansion of these policies globally. Another major change was the rise of modern macroeconomic policy aimed at mitigating recessions.
This idea, combined with the growing view that the stabilized labor market launched in a labor market, central banks and governments worldwide regularly intervene to prevent or mitigate recessions. While we can't definitively say these changes wouldn't have happened otherwise, it's certain that the world has not had an economic crisis as widespread.
Before we conclude, I want to once again thank Vantage Markets for sponsoring this video.
Don't forget that Vantage is running a risk-free demo trading competition with a prize pool of up to $4,000 a month. You don't need to deposit any
registration
funds.
Link is below in the description and comments. or thermaithers. There were some complex economic parts in the middle, but hopefully you gained enough knowledge to Google search or ask ChatGPT for more details. I'm William. Don't forget to subscribe so you don't miss any of our videos. Goodbye and see you next time.